Hello friends, welcome to this edition of Fixed Income Outlook from Canara Robeco. I am Avnish Jain. The Indian elections threw a big surprise and we'll talk about it later. Let's look at global factors first. Globally, situation remains similar as last month. The global factors, especially inflation and growth, continue to moderate, but not at a pace which is acceptable to the central bankers. So they are waiting and watching before they make any rate moves. The expectation of the market now is that Fed will move, or the US Federal Reserve will first move on rate cut in September of 24, and they are pricing in only about 2 rate cuts this year. This is a far cry from 6 rate cuts which were earlier predicted in January of 24. So a lot of things have changed in the past 6 months and will continue to change as data comes in. Recent US data remains a bit softish, so that is a positive for bond markets. Oil prices also have declined in the last 1 week as the OPEC Plus cartel has now decided to bring back production cuts which were there for last 2-3 years because it's hurting them and their revenues. This is positive for India because India is the largest importer of oil. Oil prices dropped to around $72 a barrel from about $80-$85 range in the last 1 or 2 weeks. Apart from that, we saw a rate cut by Canada yesterday, and probably the ECB will also move slowly in next couple of days, or probably today. And US will continue to wait out on rate cut. As already discussed, we are expecting, as market expectations are, of a rate cut in September. Data there remains strong. Markets will await the US labor data on Friday. If it is weak, then markets will start pricing in probably an earlier rate cut. So again, it is back to data dependency by the markets and by the central bankers. And data has confounded in the past all the economists as well as all the forecasters, and that will continue to happen in the near term. Coming to India, the Indian elections threw a big curveball or a surprise as we saw the NDA mandate coming down from about 350 seats in the last election to 293. It was a bit of setback for the NDA government as BJP also as a standalone got 240 against 300 plus last time. This could likely have fiscal implications as the government in the earlier avatar in the previous government was focused on infrastructure development, and that some of that expenditure may shift to consumer side and rural side because the analysis of the election results shows that rural areas have voted probably on the back of lack of jobs, price pressures, and other factors which probably were not factored in by the government. So in the next budget, which is scheduled for probably July, we have to wait and watch how things develop. We anticipate that the government may shift some of the infrastructure expenditure to consumption side, consumer side, and push more on the rural side. However, we don't expect any change in the 5.1% fiscal deficit, which is indicated in the interim budget in February. Because RBI already gave 1 lakh crores extra in terms of dividend to government, which should be enough for government to manage the fiscal around 5.1%. Markets reversed sharply after steep fall on the election day because there was some concerns whether government, NDA could form the government. But once that was clear, markets have recovered. And even the debt markets and equity markets are back in the rally mode. The biggest factor obviously for bond markets have been the inclusion in the JP Morgan index. That inclusion will start from June, and by June end, a 1% addition has to be made by all the passive funds which are following the JP Morgan Emerging Bond Index as a benchmark. And that means that they have to come and buy Indian bonds, especially Indian government bonds. This year, if we look at the current year today inflows in FI debt, we are close to $7.88 billion. So that's a huge inflow for debt, and that has supported the 10-year yield. 10-year yield fell below 7% after almost a year, We saw a low of 6.95, but on election day there was some reversal to around 705, 710 levels. But now again the market is falling. We saw yields fall close to 7% now again. So clearly markets have discounted the elections and they are looking forward to the policy now, policy making in the budget, and that is what we have to look forward to. In terms of market yield movements, RBI is unlikely to cut before Fed. So we will expect RBI to probably move in the third quarter of this year. Around October is the first chance probably RBI will get to cut rates. By that time, inflation will also be trending down. While inflation in May may be a little higher on back of base effect, but we do expect that from here on, inflation from June onwards should show a declining trend. Though there are some concerns on food inflation, which probably RBI will point out in the monetary policy which is ongoing, and it will be announced tomorrow. So again, we wait and watch on RBI monetary policy. We don't anticipate any change in policy rates or stance. RBI will also be looking forward to the fiscal numbers which will be announced in July budget. And I think they will also wait out the interim period before taking any hard decisions. In terms of market movement, we already talked about G-Sec yields coming down. Corporate bonds have been broadly on the flattish side with the downward bias. So we continue to think that rates will move downwards probably later this year. Rate cut cycle this time is likely to be a little shallower. We don't anticipate more than 50 basis rate cut in probably the next 6 to 12 months. This is because Indian growth story remains strong, and with the NDA government back on the hot seat, we anticipate most of the government policies going forward to remain to be continuity be there, and policies to be constructive for markets. Rate markets will continue to be little volatile in the near term till the budget, but we anticipate that rate eventually will move lower in the next 12 to 18 months. For investors, they should continue to invest systematically. There is no expectation of immediate rate cut, so they could take their time to invest in the next few months. For investors, we recommend banking and PSU debt kind of funds where we have moderate duration and carry is there. So it's a combination of duration and carry, medium duration and carry. And that is suitable from a 2 to 3 year perspective. This period will also capture any rate moves, which easing happening over the next 12 to 18 months. For short-term investors, the low duration product is a good option from 6 to 12 months perspective, as the 1 year yield is at almost the highest level in the yield curve. Because of expectation of rate cuts, the medium to long duration curve is little down and the curve is inverted from 1 year onward. So the 1 year point provides good yield in comparison to the longer duration of the part of the yield curve. As usual, investors should look at the risk appetite as well as their duration horizons, maturity horizons to invest in any debt fund. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.